Okay, folks, it's 10 o'clock, and welcome to our NFIB Pennsylvania webinar, Finance Your Success and What Lenders Are Looking For in a Small Business. We're going to give you some inside information on what the banks, credit unions, and other financial institutions are considering when they look at your documentation, at your history. And I'd now like to go forth and thank our sponsors. They are Capital Blue Cross, which works in the central Pennsylvania area in the healthcare field, and also the law firm McNees, Wallace, and Nurick. Our presenter today is Eric Fischer. He's Vice President of Business Lending Sales at Members First Credit Union. And Eric, first, thank you so much for doing this. We greatly appreciate it. I would like to first just say that feel free to ask questions, and when you do hit enter, I'll try to get them in. But at minimum, Eric's more than happy to answer questions, and he will have his email up at the end, so if you have a pencil, you might want to jot it down. So Eric, what can you tell these business folks who are on with us today? What do you folks consider when you're going through to determine, are they a credit risk or are they credit worthy?
Well, hopefully a lot. But thank you, Suzanne. It's a real pleasure to be here. I appreciate the opportunity, and hopefully I can shed some light and maybe clear some of the fog for folks on what are those folks thinking about when I present my loan to them, and how are they thinking about me and my loan, and to make that credit decision. So with that, we'll go straight into it. So how do we make our decisions? All bankers, and I've worked for a couple financial institutions, they frame up their decision making on loans with what we call the 5 C's of credit. And now, to be fair, I would tell you I've seen different variations of this, different language that they use, maybe different words for different C's, but they all kind of wrap themselves up into these 5 characteristics, if you will. And the first one is character. And we're going to go into every one of these into a little bit of detail for you. The second one is cash flow. The third is collateral. The fourth is capital. And then the fifth one is conditions. And what we'll do is we'll spend a little bit of time this morning on each of those for you and try to give you some insight. So what is character to a banker? I always like to say this to folks, and this is sort of the behind-the-scenes kind of look at this. I always tell folks that if I sense a lack of character in a borrower, I'm not going to make a loan. I will actually find a way to deny a loan. There's always a way. I can tell you, for pretty much every loan I've ever looked at, there's always a way to deny a loan. I don't like to do it. But if I sense someone may be lying to me, or I find out for sure they are, I can promise you I'll find a way to deny a loan. Character, I would tell you, is probably the most important aspect to making a loan decision, but also for a banker is probably the hardest one to measure. It's very difficult to measure.
I was going to say yikes, because even if you're not a liar, what else is there that you have to be cautious about?
And that's a great question. And I think we'll go through some of that, but we'll go through some of these as we go along. So are you somebody with whom banks want to do business? Well, I know Suzanne and I had a small conversation beforehand here, and she talked to me about, a lot of businesses are out there in their communities, and they're doing good things out there, and they might be contributing to nonprofits or involved in nonprofits. And the answer, is we take that into account. We want to do business with good people, and we will typically we'll talk to other folks, believe it or not, and say, hey, do you happen to know this person? Do you know John or Sally? I mean, these good people to work with. And a lot of times you can find out because bankers tend to be fairly interconnected in the marketplace. So that's part of it. But how do we assess all this? Well, here's the big one. And people always ask me, well, what about these credit scores that you pull on us? Are these important? And as I mentioned before, character is really important as far as the loan decision process, but we really only have one way to measure it objectively outside of these conversations and things that I talked about, and that's with your credit score. That credit score really gives us our one objective measurement of how you handle credit. Do you pay people back on time? Do you typically get, over leveraged in your lending, personal lending, or do you handle things really well and properly? It typically comes out fairly clearly with a credit report. So it's really, really important, those credit scores. Keep them up as best you can. How else do we assess it? Well, typically a business lender, commercial lender is going to want to sit down with you face to face. It's the only way I do business personally. I believe that's where relationships are formed. And I like to sit with somebody face to face. And I guess I hate to say it this way, but most bankers I know have pretty good sniffers. We can sort of smell when someone is not maybe being forthright and honest with us. I hate to say it that way, but it usually comes across pretty clearly when we're talking with folks. So that's one of the ways we do it. We get references. Talked about, who out there might know this person, and have you ever done business with it? It might be a supplier of yours. It might be a customer of yours. A lot of times we can talk with somebody who might know you. And
now, do you get those names from the person who's trying to borrow the money?
Sometimes, yes. Great question. Sometimes I'll get it during the credit process with some of the information that we ask for. Other times I might know somebody in the community who I'm pretty sure is going to know you. Yeah. So great question. We do background checks. These are a couple of the systems that you see here, but we can pull reports on folks, both businesses and personal. Well, these would be business reports that we're pulling, just to see if there are any, say, tax liens against you, or maybe there are lawsuits that are being filed against you. That would be another way. The yellow flag that would go up to say, well, I probably need to talk to my borrower, my prospect, and can explain to me what's happening here. Those are other ways we do it.
So it won't wipe you out if something's there, as long as there's a clear and good explanation, because anyone can sue you,
Yeah, that's exactly right. And so the straight answer to your question is no, it doesn't wipe you out automatically. But it always raises that yellow flag with folks. And so I have some explaining to do, right? If I'm your lender, I'm going to have to talk to my credit folks and, give them a story and an explanation of what's going on there. Yeah. If it's not a reasonable explanation, I'm probably not going to make a loan. That's probably what's going to happen. So credit reports. We talked a little bit about it, and here, this provides us at least some kind of viewpoint on how owners pay their bills. I will say it this way: I try to be really direct about it. They really are weighed very heavily when we make loan decisions. A lot of folks ask me that question, and I would tell you that every bank has sort of different levels of what they consider good and bad credit. Most folks consider a 700 plus credit score good, no issues there. If you're between 650 and 700 or so, that usually means, okay, something's going on there and probably something I need to dig into. When you get below about 650, the questions really start rising, and most bankers will start to lean away. And I have a silly little saying, this is sort of that behind the scenes curtain look: if it starts with a 5, it ain't alive. I don't think that's my silly way of saying it internally here, but I've never done a loan with someone who's had a credit score that starts with a 5, unless they have other folks willing to sign on the loan for them that do have good credit. But what might you want to know about your credit scores? Well, here are the websites for each of the credit scoring operations out there: TransUnion, Equifax, and Experian. What I've always told folks is there are free credit reports out there. Be careful. Be careful with folks that advertise free credit reports. They're not always free. The one I know to be free, at least it has, at least up to last year that I know, is this one I've given you, which is annualcreditreport.com. It's always a good idea to go out and check your credit report every once in a while so you're up to date on it. Here we go. There are some ranges there for you for credit scores we talked about. Your score could be from anywhere from 375 to 900. I've never seen a 900. I think the highest score I've ever seen was 815 or so, which is just sparkling. If you're in the 800s, you've got great credit. Everybody's leaning in. All lenders will lean in if you have good credit like that. And this sort of summarizes what we talked about a little bit. How do credit scoring bureaus come up with your score? Now, what I'll tell you is, I'm not an expert at it, and no banker is, but this is information that credit reporting agencies put out for you to read. 35% of it is in your payment history. 30% of it is the amount of total money you owe. 15% is the length of that credit history, meaning that the longer you've had credit history with somebody, the better. If you're constantly getting new credit, that actually pulls your credit score down.
So even if you take loans and pay them off totally, that may not be a good thing if it's repeat behavior?
If it's repeat behavior, yeah. Yeah, that'll pull your credit score down, so that's right. Have you applied for any new credit? If you've applied for, a substantial amount of new credit lately, that will pull your score down a little bit. And then also the types of credit in use. Generally, revolving credit is a little riskier than term type credit. So in other words, if you have a lot of credit card debt that's out there that's on a revolving basis, that's seen as riskier behavior versus you having a mortgage, which is a term type debt.
So quick question, the folks on the phone, let's say their credit isn't 815 and they're somewhere in the midst there, but they'd like to make it look a little more sparkling. Is there anything that you know that they can do in a 6-month period to be able to borrow money and what's the way to get it up kind of short term? Is there?
There are. Most of the ways that I've seen folks do it is sometimes there's a temporary blip on their credit report, such as there's a medical collections out there. That's actually more common than you'd think because I don't know how everybody else feels about it, but whenever I get my medical bill, it's really hard to understand. So sometimes you might have a $200 bill out there. The best thing to do would be to pull your credit report and see what's on it. Go to that annual credit report, the free site that I gave you, pull it so you know what's on it.
And pay off what you can quick that looks negative.
If you have a $200 collection out there for a medical bill, go pay it. Just get rid of it. That's the fastest way I've seen people improve their credit reports. The other ways are there could be an error. There could be an error on your credit report. Now, I'm not going to say that's necessarily easy to fix in 6 months, but it can be done. Most people will have to employ an attorney to help them out with those kinds of things. Sometimes, though, I don't want to scare you, sometimes it's as easy as calling up the Credit Reporting Bureau, TransUnion, and saying, hey, there's an error here, and they'll help you fix it right away. It's pretty quick. Yeah. So being active is a good thing there. Yeah, great question. So we also talk about your management ability when we talk about character. Well, what does that mean? How experienced are you? And your team, you might have a team of folks there. Do you have, well, as I'm talking to you, here's where those face-to-face meetings, do you have some at least basic financial acumen? Do you understand, for the most part, what a financial statement is and when you're looking at it? Because that gives us an idea of how well you can run the business as you're looking at your financial reports monthly or quarterly. Do you have a handle on the company's books? Or, if I'm asking you basic questions like, well, what were your annual revenues last year? You should know that. And if you don't know that, it's a little bit of a flag for me. Okay, we might not know our business as well as we should. How quickly can you provide information to a bank? This sounds like such a silly little thing, but it is true. If I say to folks, well, can you give me 3 years of your tax returns, and can you get me this personal financial statement? If it takes you 2 months to provide that to me, I start wondering. Now I'm going to call you. I'll probably have called you a couple times in there, but it starts to me, why does it take so long to get the financial information to me? Not the be all end all, but all kinds of, it sort of adds into the full picture, if you will.
And that's important for small business to know because they get so very busy. But that is important. That will help them.
It is, and I try to say it this way, and I really do believe it. I don't think I'm lying to myself. Most of the things we ask businesses for are really as good for them as they are for us. So I always kind of look at my relationship with a borrower as a partnership, even though I know I'm not your partner. I don't own anything, but I do try to behave like it's a partnership. I think most of the things we ask for are helpful for business owners to know. Do you have a dashboard to monitor financials? What does that mean? Well, most businesses have maybe 3, 4, 5 things that are critical for them to monitor on a weekly and monthly basis. Can you nail those for me? Eric, you know what, we're doing well here, 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 and here. I know that here's where our receivables are, and we monitor those. They aren't beyond 15 days typically. I know where my revenue is. I monitor that weekly. You know, are there a couple things that you're monitoring? If you can present that to a lender, boy, it makes me feel a lot more comfortable that you're on top of your game. How about marketing? Do you have a plan? How do you market your business? Do you have a specialist there that does that for you? Sales ability is critical, and especially for small business owners. And here's the other thing we know: you have to wear all these hats. You know, most small business owners have to wear 10, 12, 14 hats. Well, sales is a really important function of that. And some of that will come straight out when we're talking to you. I'll feel it and see it, because you'll be selling to me as much as you're selling to your clients and customers. Do you have a business plan? Helps. I know you're organized. It's even good for existing businesses. And we're going to talk a little bit about that if you hang on later on. We're going to talk about what a business plan looks like. Those business plans should have projections and budgets. And then that's the credibility of management. When I ask you questions, are the answers forthright, straightforward? And some of those references that I talked about will help me with credibility. Okay. So the second one is cash flow. Well, what is cash flow? Cash flow is the primary source of you repaying your loan to the bank or the credit union. And we want to measure it. It ultimately measures what is your capacity, your ability to repay the loan through your business operations. There it is, cash flow from operations. It also talks about your cash-to-cash cycles of the business, which we're gonna look at here on the next slide. I'll show you that. Banks want to see what? We want to see historical cash flow. One thing I always tell people is there are multiple ways of financing your business. One of them is to go to a bank or a credit union, and we tend to be, in the bank and credit union, risk averse. So we actually like to see historically you being able to cash flow your business. If I have to go into projected cash flows, meaning, okay, well, the last 3 years I couldn't cash flow this debt, but I have a new project, and the new project's going to bring in new revenue, and if you give me this piece of debt, here's how things are going to go in the future. Once I have to go to that projected viewpoint, that's a riskier loan for banks. And it doesn't mean you're dead in the water. It does mean that banks and credit unions will start to lean back a little bit and say, okay, I understand it's what you plan to do, but that's a riskier proposition for me. And will we be earning enough, will we get enough return for our investment? You know, in the banks and the credit unions, in the broad scheme of financing, we only earn a 3 to 3.5% gross margin on our business. It's really tight. And so the reason we're risk averse is because we can't afford to take losses. So once I have to go to projected, it becomes a riskier venture for me. It might not fit our risk profile. We'd like to see a break-even analysis. We're going to talk about that later too and what that looks like. And that essentially represents how much revenue do you need to make to cover your expenses plus your debt payments on a one-to-one level. So if you have, for instance, expenses and debt payments are $100,000 a year, you need to make at least $100,000 in revenue to cover those. We'd like to see a calculation for that. Okay, back to that cash-to-cash cycle. These are some of the things that we look at, and we need to understand this. And so it's always good if a borrower can explain this to us, how your cash cycle works in your business. What you see up on the screen here is probably the best seen as a cash flow for like a manufacturer, if you will. So at the top of the circle here, cash is coming in. You've sold something and that cash has come back to you. That's the beginning of the cash cycle. Then what you do is you go out and you buy materials as a manufacturer. And then I receive those materials, and that creates an accounts payable. So I owe somebody some money. I might not have to pay them today, but I do owe them some money. Then I make the product, and I incur some expenses when I do it. Cash is going out again. I got cash going out the door. Then I sell my product, and I create an accounts receivable. So I might give net 30 terms to somebody, which means I won't get paid for 30 days. But I've sold something, and I don't have cash coming in yet. My AP might be, my accounts payable might be due, so maybe now is the time I have to pay somebody, more cash going out the door. And then I have to wait until I collect those accounts receivable, everything that I've sold and those invoices I've sent out the door. I have to wait, and I have to wait, and that's the only time the cash starts to come back in, is actually getting those checks from my clients. So how long is that? Is it net 15, net 30 days? And then the last part is, now that the cash has come in, now what do I do with that cash? I have a decision to make. Do I distribute it out to my owners, or do I reinvest it back into the business? Does it stay in the business?
And you want to know every detail about that as well, I assume.
All of it, yep. And we'll see most of it in the financials. It's part of the reason why we ask for such detail in the financials. We'll see most of it, but there are going to be questions there too. Hey, can you explain to me, let's talk about your accounts payables for a second. Can you give me an accounts payable report, which will show me who you owe money to, how long you've owed them money? Is that typical for you? What typical terms did they give you? So I can understand that part of the cash cycle. As well as accounts receivables. Can you give me an accounts receivables report? How many folks owe you money? How long have they owed you money? Well, who's within 30 days of their invoice date? Who's within 60 days? Who's within 90 days? Those are all really important for us to understand. Yep. Okay, now, we summarize a bunch of stuff. Now that's what I just went through is the really nitty-gritty fine detail of it. And then we summarize your cash flow in what's called a debt coverage ratio. Also, some people will call it a debt service coverage ratio. Same thing, if you hear it both ways. And here's the simplistic way of calculating it. It can get more complicated than this, but I don't think most small business owners need to really get more detail than what I'm showing you here. It starts with your net profit for the year, and then what we do is we add back depreciation, which is a non-cash expenditure. That's why we add it back. If you happen to have amortization expense on your income statement, we'll add that too, because that's a non-cash expenditure. Then we're going to add your interest expense. If you have interest expense on your income statement, we're going to add that to it as well. And that top side of the equation is the cash that you have available to service all the debt that you have. So we're going to take all that cash that's available, and then we're going to divide that by all the debt payments that you have. So that would include all the term loans that you have, and then if you have lines of credit out there, we will assume that your line of credit is fully drawn upon and calculate what monthly interest payment you'll need to make off of that. So we add up all those debt payments, and we divide them, and most banks will want to see that ratio that you just calculated to be 1.2 or greater. Once you hit 1.2, then that provides enough cushion margin. You basically have a 20% margin there for bumps in the road that you might hit. And we'll do that both on a historical and a projected basis. I'm going to keep moving on because I'm going to try to keep to my time schedule as best I can. Okay, next C is collateral. So collateral is the secondary source of getting repaid. So let's say things don't work out. And next thing you know, a borrower has defaulted. Are there other means for the bank or credit union to get themselves out of the debt? Can we liquidate something? That's important. It's important because of that risk-averse nature that banks and credit unions are, and that small gross margin that we work with. We need another way to get out if we can. And what we'll do is we'll typically look at your balance sheet to see what's there on your balance sheet that we can take as collateral. We also look at people's homes, and we look at people's maybe you have a commercial piece of real estate that we can use. We'll look at all these things to find collateral. Where do we run into, the banks or credit, where do we run into obstacles when it comes to collateralizing a loan? The typical places are when we're doing working capital loans, like lines of credit. And the reason for that is because the accounts receivable and the inventory that we typically take as collateral don't hold value like real estate. And the truth is, here we go behind the curtain again, banks and credit unions know that in the case of default and when things really go bad, most of those accounts receivables and the inventory, they go away. And they don't even exist by the time we're there to try to liquidate them. Why is that? That's because business owners are doing what they should be doing. They're trying to survive as much as they can. And so they collect on all the receivables that they possibly can. They sell as much inventory as they can to keep that cash flow going. And typically by the end, there isn't anything left. That's reality. So banks will always hesitate a little bit. Credit unions will always hesitate a little bit. Is that what? If that's what I'm taking as collateral, okay. Doesn't mean I can't do the loan. Just means I recognize there's extra risk there. Collateral is always margined. Well, what does that mean? And for those of you who have talked to a bank or credit union, we don't give you credit for 100% of the value of that collateral. Typically, we'll take the real estate and get an appraisal on it, and we'll only give you credit for 80% of it. Okay, that really stinks, right? Everybody says, why are you doing that to me? The reason for that is because in a case of liquidation, where a bank has to take a piece of real estate back, there's no way we're going to get 100% of the value of that piece of real estate. In fact, I can almost guarantee you we won't get 80% either. It's typically less than that. Because once I take it back, everybody's looking for a good deal when they buy it from me. Same thing with new equipment, again, that accounts receivable and inventory, we margin it typically at 70% or 50%. Because we know most of it's just not going to be there at the end of the day. So that's collateral. That's, I think, the third C. Okay, guarantees. I'm going to stop for a second and talk a little bit about guarantees because this comes up. A lot of people ask me, well, aren't guarantees collateral? Well, they're not, but they're really, really important for banks. Why is that? It's because a personal guarantee shows the owner's willingness that if things go bad, they're going to step up to the plate and they're going to make good on the loan. And that's a little bit part of character too, I would tell you. There's some character element in that for me when I'm talking to folks. Hey, are you in? Are you all in on this? Because if you're not willing to sign up for this deal, why would I? Right? So guarantees are really, really important. It's difficult, I would tell you, to get a loan without a guarantee. The folks that do are typically those folks that have been in business for a very long time. Well, what's that? I don't have an exact number, but 15, 20 years, been around a long time, and they have a really, really solid balance sheet for the business. And what does that mean? It basically means that if you have a rocky time and for a year or two or three, I can look at the balance sheet and clearly see that the business can withstand some tough times. The other part is a corporate guarantee might also be needed, and that's typically dependent on how your ownership is structured. Most businesses are very simple structures. You might just have an LLC as the business and you might own it personally, but some folks structure their businesses in a more complicated fashion. You might have a company that is owned partially by another corporate entity, along with people. Now, the structures could be very similar, very simple, or very, very complicated. And in the case where corporations are owning another corporation, I might ask that corporation to guarantee as well. So very important when we're looking at loans. Okay, now I'm going back to another C, if you don't mind. And that one is capital. So what is capital? Capital is partially, when we're looking at the amount of cash that you can put into a project. What do banks typically look for? They look for that 20% that you hear about if you've talked to one. If you're buying a property, we typically ask you to put 20% cash down on it. It may vary based upon what assets you're financing. If I'm doing a commercial vehicle for someone, or maybe and if it's not a large amount, I might not require you to have 80% in. We might do 90% financing on something like that. There are programs out there to help you if you don't have 20%. SBA loans exist out there to try to get deals done with less than 20%, or there are state programs out there too. So there are ways to get around that cash in. But I will tell you, and you'll see this later, this is a banking terminology, and I've had somebody look at me very quizzically when I've said this to them, that I need you to have skin in the game. Part of that cash injection is about, well, what do you have in this game if something goes wrong? Do you have any skin in it at all, or is it really easy for you to walk away? If you don't have any cash into it, it's a lot easier to walk away from a project if things start going bad. That's what we call skin in the game. There it is. That skin in the game gives you that reason to get out of bed every morning and make sure you're getting it done. So always important for banks and credit unions. Other capital would be what kind of net worth do you have on your balance sheet. So we're going to look at the company's balance sheet to check the net worth. There's book value of the company's equity. And then what kind of working capital do you have? And here's the way I like to explain this. So for some projects, someone might want, let's just say $500,000 to buy a building, and they can show me, hey, Eric, I've got 20%, no problem. I have $100,000 I can put down on this. Well, that's great, but they don't have anything else, and that's all the capital that they have. That will always give me a reason to pause, because the way I've always said it is, looks like you got enough cash to turn the key on to the motor, get the car rolling, but what happens 3 months from now, 6 months from now if you hit a bump in the road? We don't have any other working capital left, and that's going to create a problem for you and for me. We're both going to be looking at each other across the table going, oh boy, I wish we would have had more working capital at the beginning of this thing. So that's capital. And the last C is conditions. So what are conditions? Conditions is a little bit of a catch-all statement where we're looking at maybe the conditions of your industry and market. What does your industry look like? Is it in a downward phase? Is it on an upward trend? Sometimes I use this analogy. At one time I'm sure that the world needed blacksmiths like you couldn't believe. Out there hammering horseshoes. At some point in time, probably when the automobile came around, the need for blacksmiths started to decline. There would be a condition of an industry that's in decline, and I would probably hesitate. Is this something I really want to put money into as a loan? Conversely, there are industries on the upward climb, and we'll take that into consideration too. Wow, this is a big thing. This is typically up and coming, or this is clearly up and coming. This is something that I might want to put some money into. What are the national, state, and local economic conditions? Same thing. Are we in a period of recession? 2009, I know from experience, everybody had a tough time getting loans then. It was because all the banks were looking at the conditions of the market and saying, wow, it's a risky business right now, putting money out there. What are your specific company conditions? I'm trying to think of an example there, but what's your ownership structure like? Are the owners looking to retire soon? Are they aged? Do we have old owners that could possibly pass away in the near future? That would be a condition of your business. Things of that nature. What's your management capability? The conditions of the management, are they in upheaval? Are we changing management a lot right now? That would be a company-specific condition. What's driving your deal? And the second question is, why are you doing this? Okay, so this is a really huge question, and I teach all my lenders to ask this and make sure they understand it. As much as from a sales perspective as a credit perspective, because if I don't understand why you're engaging in this transaction, I probably can't help you the right way. Well, what do I mean by that? Sometimes I need to look at folks and say, I might not be able to do what you're asking me to do the way you're asking me to do it, but I can do it another way and still reach your goal. Maybe I can structure the loan a little bit differently, but I can't do that properly unless I know exactly why you're doing it. So, for instance, Eric, I want to refinance this piece of debt. And my number one goal is to improve my cash flow. That's what I need to do. Oh, well, I can do that in a couple ways. I might be able to do that simply because I'm saving on interest rate. That's great. Or I might not be able to save you an interest rate. Your interest rate might be going up. I can't save it that way, but I could do it by extending the term of your loan. That would be the other way. Unless I understand why you're doing what you're doing, I really can't service you properly. And I would always, I would not only encourage you to explain that to your lender, but if your lender isn't asking you, I would hesitate on your side. So, this is somebody I really want to work with, because they don't seem to understand why I'm doing what I'm doing.
But I have a quick question about that. You're just glad to get the money. Should you be scrutinizing the person you're borrowing from when they're the one with the cash?
Yes. Yes, you should. And I mean that as absolutely sincerely as I can.
For what reason?
Because your relationship with your banker is really important. And you want to make sure that you're dealing with somebody who understands you and is willing to understand you. Because even as times go bad, and we're going to talk about that a little bit, you want to make sure you're dealing with somebody who's listening. It's really important. As if they're not listening, they're probably not going to be able to help you if you hit a rough patch, or they might not be willing to help you. So I consider it a relationship with your banker, and anybody who's run through a rough moment with a lender or a banker, they've had a rough time in their business, will tell you that. We'll say, well, I either had a good or a bad relationship with my banker, and that either wreaked havoc on me, or I had this great relationship and they really helped me through. It's really important. So now I will to add to that though, you might not have a choice. If you're talking to 4 or 5 banks and you've gotten 4 no's, and the 5th bank's going to say yes, well, that you might not have a choice.
Right.
But I still think it's as much as an interview for you, just like going in an interview for a job. It's as much as an interview for you as it is for them. If you don't think you can trust your banker, well, that's a big problem. that's a problem too. Same thing. So, great question. Okay, and then do you have a handle? As I'm talking, do you have a handle on your industry conditions and maybe the national GDP conditions and things like that? Okay, I'm going to move on here. Keep going. All right, so here are some of the financial measures and ratios. I'm not going to go into every one of them. You can certainly email me afterwards and ask me what this means or what that means. But here are some of the things that we measure. Debt service coverage ratio we talked about. We'll measure your current ratio, which is a measurement of your liquidity. We look at debt to tangible net worth. We'll look at now if I'm looking at a personal guarantor, well, what's your personal debt to income, which is the same measurement a financer will look at when you're looking for a home loan or a consumer loan. And what's your personal tangible net worth? How much of net worth do you have to support a loan if it happens to go bad and I need to rely on your personal guarantee to help get me paid back? All right, so having said all that, this is sort of that big old summary of sizing up the risk. What do we look at? All of those things I talked about, but it's about your personal credit history, it's your management ability, it's overall liquidity in the business and your personal liquidity, it's about profitability. We look at that debt service coverage ratio, the financial leverages, I'm going to go back now. Financial leverages would be things like debt to tangible net worth back here. Okay. Operational leverage, this is something I haven't covered, but I'll talk a little bit about now. Some businesses are heavily capital intensive, meaning you have to have a lot of equipment, manufacturer would be one, a lot of equipment and overhead to make it run. Well, that adds risk to the business because you have to drive a lot more revenue through that business for a break even. Versus some businesses are clearly more, the expenses are more variable. In other words, if you're very capital intensive, you have a fixed level of expenses that sits there. No matter whether you make $1 of revenue or $6 million of revenue, I have fixed expenses sitting there. They're always going to be there every day. Versus a company that might be more of a variable level of expenses, which might be like a service company. If you were an engineer, let's say, sitting at your desk and you did engineering work with a one-man shop, your expenses would be congruent with the level of revenue that you're doing. The more revenue that you're doing, the more contracts that you're doing are going to increase, your expenses will increase along with the revenue. Those are less risky propositions because as revenue declines, so do your expenses. So we look at those operational leverages too. And then that collateral and the guarantors and the strength of the guarantors that we have behind it. Excuse me. Okay, A quick look inside the lending process. Not going to go through every one of these, but this is typically what it looks like. Typically, you have an initial meeting with your lender, and they're going to ask to collect some financial information from you. Second thing that's going to happen is that's when we'll pull credit reports. We're going to spread financials, which is a fancy way of saying we're going to organize your financials in a way that we're used to looking at them. We'll take them, we take them off the page of your tax return and put them in sort of a spreadsheet that organizes it for us. And we do what's called a write-up or a credit memorandum, which is summarizing the deal so that a lender can discuss the deal with a credit officer. After those meetings, we'll typically have a follow-up meeting with you. There are going to be questions from our credit folks. It's our job to run this deal by somebody, gather up their questions, the credit person's questions. We're going to ask you more questions and get those questions answered. If it looks like a deal that is doable, a lender will typically then give you what's called a term sheet. And that is, okay, I think this is a deal we can get to the finish line. Here's what the structure of that deal might look like. This is who we see the borrower as. We're going to take these folks as guarantors. Here's the amount of the loan we're willing to do. Here's the interest rate. Here's the amortization or the length of the loan that we'll do. Here's the collateral we'd like to take. And we're going to give that to you and say, hey, what do you think? Is this a deal that you're willing to look at? Do you want this deal? And if you do, then the lender will turn around and we'll get the loan formally approved, completely approved, and then we'll issue you, stage 6 would be a formal commitment letter that says, it's fully approved, we are committed to giving you this loan under these terms and conditions. If you accept that commitment letter, say, yep, I'm good, this is the deal, I'm definitely moving forward to close it. We'll start scheduled closing, appraisals will have been ordered, we'll move all that forward. The key to that step, I always tell borrowers, is once you sign a commitment letter, you're in. And what that means is the bank or the credit union is going to start incurring expenses. We're going to start pulling some probably tax lien searches, things of that nature. We'll start incurring expenses. And if for some reason you decide not to close the loan later on, you're going to get a bill at that point. You're all good. You don't owe anything typically up until step 6 after you've signed that formal commitment letter. And then you're in. And if I happen to order appraisals and everything else, you're going to need to pay for that whether you close it or not. And then, let's see, so step 7, we schedule the closing. There are other documents you'll need to gather, such as your corporate documents. If you're an LLC, you'll need to show us your corporate documents for that LLC. We prepare the loan docs, then we sit for closing in step 8 and fund your loan. If there's construction involved, we control those disbursements over a period of time. I'm not going to get into those details. And afterwards, stage 9 is we stay in it. The difference between a commercial loan and a consumer loan is commercial lenders should stay in that deal with you over the years, and you should be talking to them. So we'll be servicing your loan. You'll need to provide financials to the lender every year. Same thing, basically the same financials you provided them to start with, you'll need to provide that to them annually. Okay, and what kind of questions might a bank ask me? A whole lot, and I'm not going to go over these, but how do you make money? Who are your largest customers? There's one. Do you have concentration in those customer accounts? Does anybody represent over 20% of your revenue? What are those payment terms? Is it net 15, net 30? Who's your competition? What is the exact ownership structure of your company? We need to know. You're an LLC or an S corporation? Oh, I'm an S corporation. Well, who owns it? And I need to know all 100%.
And I think people may want to refer to this if they're about to go get a loan. So I will post this when I'll probably take the entire webinar and post it on nfib.com/PA by the next day or so you can look back.
Yep, great. If revenue went up or down, why? Again, I'm not going to go through all these, but if you took company out of the cash out of the company, why did you do that? Did you have to do that, or did you just do it because you could? That's okay. What's driving that need for financing? Very important. I want to understand why. Okay, I'm not going to go over those for the sake of time. What information should I be prepared to provide? Well, if you're in a project, you should be able to provide an itemized project cost breakdown. You need to know what all the money is being used. How much money do you need and what's it being used for? Do you have I need a sales agreement if you're buying something like a vehicle or a building. Here are those financials that we're going to be looking for. Interim financials. If we're in the middle of a year, like in June, we like to see how can you give me financials for the beginning of the year, maybe the first quarter. If we're doing projected-based financing, okay, can you give me those projections? What is your next year going to look like? If you have a business plan, you can give me. There's that accounts receivable and accounts payable aging reports I talked about. Do you have any backlogs if you're a contractor? Personal financial statements. This is your personal balance sheet that we ask for. There's your personal tax returns. Resumes. I think Suzanne asked me about how can you determine someone's management acumen. Well, if you give me a resume, then that gives me your background, all the things that you've done. Okay, I think this is the last. I have 2 more slides. Hang in there. Every business needs bail services.
That sounds scary. Yikes.
Yeah, it's not about bailing you out of jail. That would be tough. Nope. Here's what it stands for. You need a good banker, you need a good accountant, you need a good insurance provider, and you need good legal services. Okay, so why do we care about that? Well, I might ask you, well, who's the accountant that you use, and who's your attorney, and who do you use in insurance? And it really helps when I know who those folks are, and I know that you have folks to reach out to beyond me to get advice from. And when you have a good team of advice folks, I start to feel more comfortable. Yeah, because I know that you'll get good advice, not just from me. So we'll want to know about them. We'll want to know who they are, and in some cases we'll talk to them during the process. Things to think about. Meet with your banker. This is about relationship building. Meet with your banker at least annually. That's a good thing. And your banker should want to meet with you at least annually, just to check in and see how things are going.
As long as they're not charging like a lawyer X number per minute, right?
I don't know of a single banker that does that.
Okay, good.
I've worked for 4 different community banks. No bankers charge for that. So it's free. The advice you get from us is free. Take it, use it. Although, sometimes it's worth what you pay for, right? So, but call your banker. You might want to bounce an idea off him or her, because a banker would love to hear that. It might present a financing opportunity for us, or we might be able to point out to you, well, you know what, you're going to need financing for that. How are you going to finance it? You're going to do it with your own cash? You might need a line of credit. You need to think about that. Always keep those lines of communication open, and always consider the timing of your needs in your conversations with your banker. Make sure your banker knows that I need to close within 20 days, or I need to close in 45 days, so that your banker is aware of that and can prep his system and his folks to get that done for you, or give you feedback to say, well, that's not going to happen, which I've had to do many times with folks. That can't happen. Question?
Well, I have noticed there aren't questions, and I'm thinking it's because you provided a ton of information, and it was really helpful. But what I am going to say is I think people may ultimately have questions when they're able to assimilate it. So Do you have an email by any chance that we could offer folks?
I do, yeah. Let me skip to that.
Okay.
And this is the last one I'm going to ever hear about. If you're having a problem, go tell your banker early, okay? It's a scary thing to do, but it's the best thing to do. You'll be able to work through it. Okay, this is bonus material. If you want to stick around, I'll go through that. But if anybody has a question, there it is.
Okay, so it's, since you're Eric Fischer, it's Fischer, Fischer, at membersfirst.org. Yeah, that would be helpful because it was pretty intensive, and I think people may have questions after they think about it. And just for me to reiterate, you may go to nfib.com/PA probably by tomorrow midday. I will put this up recorded, and you can fast scan through it. Anyway, did you want to go back through some of that other material, Eric, or do you want me to post it? How would you like to handle that?
Well, I'm happy to go over it. I know if folks want to drop off, that's fine for a matter of time. I kind of put some.
Okay, go for it. Go for it.
I'd be happy to go through it. So that business plan that came up a bunch of times, so many times folks will ask me, well, Eric, what does that business plan need to look like? So what I thought I'd do is I'd give you some information of what it might want to look like. Well, and when might I ask for it? Maybe this is a more important question. So bankers will typically ask for that if A, you're a startup business. So if you're just starting up, I definitely need to see a business plan for sure. But also, if you're in business, you've been in business for a while, and you're starting up a new project, maybe it's a new product line, I'll need to see a business plan, how it's going to work. And there's that new product line development too. If ownership or management is changing, so maybe it's not a startup business, it's been in business for 15 years, but you're buying it. So the ownership is changing. I'm going to want to see a business plan. Is there anything in there you want to change, something you might want to do differently? What does that next year look like to you? And the other big one is if it's a turnaround story. So, well, we've had a couple bad years here, and I need some financing, but we're going to turn this thing around, and here's how it's going to work. I'll definitely need to see that. But the last point I'd like to make, I put this in bold here, is a lot of people will say, they always frame that question with, well, what do you want to see? And my response to them invariably is always, well, why not do it for yourself first? That's the most important thing. Don't do it for me. Make sure you're doing it for yourself, because the process of planning is very powerful. I think it was Eisenhower once said that plans are useless, but the planning is invaluable. I think he said that right around his planning for D-Day, if I remember correctly. So I always say to folks, look, if you're putting a business plan together, don't do it for me. Do it for you, because you'll find the process really, really enlightening. Okay, this is the anatomy of a business plan, and I'm not going to go through all this. This is something that you can look at later, but section 1 is, well, what's the business? Can you describe the business to me? There's a whole bunch of sections there of how you might want to describe your business to a banker. Section 2 would be, well, what is the project that I'm talking about? Are you looking to buy a building? Well, then, can you summarize that project for me? And can you itemize the dollars that you need and where that money is going to come from? Be specific there. So, hey, Eric, I'm going to buy $1 million building. I am going to put in $300,000, and I'm asking for $700,000 from you. Really good to be succinct and specific on that for bankers. The third section is all this financial data that you're going to need. Here are some ideas of things that we like to see in there. And I'm going to go over break-even here for you. That's one we haven't talked about yet. Break-even analysis in just a second. And then supporting documents. Tax returns for the principals, that personal financial statement. Are there franchise agreements involved? Are you buying a Subway shop? Can you give me the franchise agreement there? That would be helpful. Any licenses or legal documents, things of that nature. So there's an anatomy that could help get you started. And don't forget that there are free services out there to help you. The SBDC is out there in the marketplace. They do it for free. They can help you put a business plan together. And they are partially funded by the Small Business Administration, the federal government. So they're great people to work with locally. Okay, the business, going through a little bit of this. More stuff and less fluff. Be concise. Don't be flowery. Bankers, we get these, and a lot of times they're 50 pages long, and it's a lot to consume. So more stuff and less fluff is really helpful for your banker. Answer the who, what, when, where, why, and how of your business. I'm not going to go through all these, but if you can answer a lot of these questions in your business plan, I think it'll be helpful for your lender. Here's that sources and uses that I talked about. If you can actually put together a chart like this, every banker I know looks at deals like this. What are the sources of money? What are the uses of money? Your banker might kiss you. I don't know. I might. Thank you so much. I appreciate it. But if you can just summarize the project for us and give us the sources and uses clearly, it helps a lot. And you'll notice that the uses of money add up to the sources of money. 950 and 950. You
might want to, I might take these slides and just make them available separately if people want to print them out too, instead of within the project, within the webinar. All right?
Yeah, absolutely. That pro forma income statement we talked about, well, those are these projections that we talked about. It's nice to do a 3-year summary of them. What you want to do is detail the first year as best you can by month. So month to month, January, February, March, here's what my expected income and my expenses are going to be. Do it month to month. After that second year and beyond, it gets hazy. We understand that. You can either do it by quarter or even annually. Here's what I think I'm going to do in the second year annually or the third year annually. Quarterly helps. And the reason for that, for doing it month to month and quarter to quarter, just so you know, is we also like to understand the the potential seasonality that you have in your business. It'll show in there. So for instance, an ice cream shop is going to have seasonality in the summer. The revenues are going to hit high in the summer and low over the winter months. We need to see that. Provide assumptions behind those numbers, really, really important. To at least give us what assumptions have you used behind especially the revenue number. Can you explain it to us? That would be really helpful because I'm going to get questions from my credit folks on it. And that pro forma income statement and the break-even analysis should be congruent. What I mean by that is they should mesh together. The numbers should jive. Sometimes I've seen revenue numbers in the income statement and the break-even analysis that don't jive at the end of the day.
So do your math.
Do your math and make sure it works. And do it for you. Remember, do it for you first, not just for me. Because if it doesn't make sense for you when you're doing it, maybe it's a business you don't even want to get into. All right, here's that break-even analysis. We talked about it a little bit, but it's basically making sure it's the amount of revenue that it takes to cover both your financing costs and your operating expenses. So how is it calculated? You take your financing costs, which is your principal and interest payments, plus your operating expenses, and you divide that by whatever gross margin you're expecting in your business. So if you're running in this case, if I'm running a business that typically operates at a 20% gross margin, if my P&I payments are $20,000 and my operating expenses are $80,000, that's a total of $100,000 of expenses I need to cover. If I divide my gross margin into that, that's 20% of that, then I have to make $500,000 in revenue to meet all those bills. It's really helpful when you can explain that to a lender. Okay? And here's where I talk about, do my break-even revenues and my projected income statement, are they congruent? If your break-even revenue says that I need to do $500,000, okay, to break even, and your pro forma income statements don't say that you're not going to make $500,000 in revenue until year 4, we probably have a problem. Okay, you're going to be burning cash for the first 3 years. There's that incongruency I talked about. Okay, that's it. So thank
All right,
you.
well, listen, this has been very helpful, and I'm assuming folks could email you or give you a call, and just if they can't write it all down, you're at the Mechanicsburg office of Members First Federal Credit Union.
You got it. Yeah, I'm happy to take any questions.
Well, listen, thank you so very much. Oh, wait, I do see one here. Bear with me for a second. Someone's asking if they should be able to print out the whole slideshow. And like I said, it is information intensive. So what I'm going to do is I'm also going to have available that I'll email everybody who's on the call. I will go ahead and you don't have a problem if I email them all the slides, do you, Eric?
Not at all, no.
Okay, then that way you can print them out yourself. Well, listen, thank you so very much. Very helpful, and I so appreciate it. And folks, we'll be announcing what our next webinar is, which will have to do with franchising your business. Next month we'll have a date, and I'll be sending out an email about that. That will be in June. Thank you, Eric. Take care, and everyone will talk to you again next month. If you have any questions, feel free to email Suzanne at nfib.com. Thanks. Bye-bye.